Through the 1920s, the Dow rose roughly sixfold, from about 63 in August 1921 to its peak of 381.17 on September 3, 1929. A major fuel was leverage. A new ecosystem of brokerage houses, investment trusts, and margin accounts let ordinary people buy stocks by putting down as little as 10% and borrowing the rest, with the shares themselves serving as collateral. Economist Irving Fisher captured the mood when he declared stock prices had reached what looked like a permanently high plateau. By October 4th, 1929, New York broker-dealers had borrowed a staggering $8.525 billion to finance these margin purchases, $1.885 billion from banks and $6.640 billion from non-bank lenders. This was a key reason the bubble was fragile. Because investors had borrowed up to 90% of their position, any meaningful price drop would force them to sell to meet margin calls. The leverage that lifted prices on the way up was wired to slam them down on the way back. Through 1929, the Federal Reserve fought the speculation. Inside the Fed, Governor Roy A. Young's board favored direct pressure, asking reserve banks to deny credit to members who lent to speculators, while George L. Harrison of the New York Fed wanted to raise the discount rate. In August 1929, the board acquiesced and the New York discount rate rose to 6%. Transmitted worldwide through the gold standard, this tightening helped slow economies and weaken the support beneath the boom before the crash even arrived. On Black Thursday, October 24th, 1929, panic selling hit the New York Stock Exchange with a then record 12.9 million shares traded. The market fell more than 11% at its intraday low before recovering to close near 299.5. Around noon, leading bankers met at J.P. Morgan & Company, 23 Wall Street pooled funds, and sent broker Richard Whitney onto the floor to bid $205 for a large block of U.S. steel above the market price. It steadied prices for about one day. On Black Monday, October 28th, the Dow fell nearly 13%, and on Black Tuesday, October 29th, a record 16,410,030 shares changed hands as it dropped about 11.7% to close at 230.07. This was the margin call machine in reverse. As prices fell, leveraged investors were forced to sell to cover their loans, which drove prices lower, which triggered more margin calls, which forced more selling. The bankers' pool could absorb one day of this, not a wave of it. By mid-November, the Dow had lost almost half its value, falling to about 199 by November 13th, and the slide would not truly stop until July 8, 1932, when the Dow closed at 41.22, its lowest of the 20th century and roughly 89% below the peak. Here's the pivot that most accounts miss. The New York Fed actually contained the immediate crash. It bought government securities, expedited discount window lending, and cut its discount rate, keeping New York banks open. The crash's impact faded within a few months, and by the fall of 1930, economic recovery appeared imminent. In the leading Fed history reading, what turned a sharp recession into the Great Depression was a separate failure in the banking system, and it came through a structure most Americans had never heard of. Historians genuinely debate the weighting of causes, but on this they broadly agree: the banking collapse was central. When the crises began, nearly 8,000 commercial banks belonged to the Federal Reserve System, but nearly 16,000 did not. Non-member banks held their reserves as deposits in correspondent banks, a reserve pyramid in which the same dollar could be counted in two places at once, sometimes as checks still in the mail. When many banks demanded cash at the same moment, the correspondents simply could not supply it. One failure could starve a whole region. In November 1930, Caldwell & Company, the largest financial holding company in the South, collapsed after its leaders lost heavily in securities. Its subsidiary Bank of Tennessee in Nashville closed on November 7th, with affiliates in Knoxville and Louisville failing on November 12th and 17th. The correspondent cascade forced scores of banks to suspend, and panic spread town to town. Then, on December 11th, 1930, the Bank of United States, the fourth largest bank in New York City, failed. By most accounts, it was the largest bank failure in U.S. history to that point, generating nationwide headlines that pulled jittery depositors out of other banks. The panics convinced bankers to hoard reserves and the public to hoard cash, and both shrank the deposit-based money supply, which at the time was the main means of payment. From the fall of 1930 through the winter of 1933, the money supply fell by nearly 30%, dragging prices down by roughly the same amount. That deflation raised the real burden of every debt, forcing banks, firms, and families into bankruptcy, cutting consumption, and pushing unemployment higher in a self-reinforcing loop. A natural experiment proved it was breakable. The Atlanta Fed acted as lender of last resort, and its district recovered, while the St. Louis Fed refused to help non-member banks, and hundreds failed. The crisis went global in the fall of 1931. On September 21st, Britain left the gold standard, and fearing the United States would follow, foreigners converted dollars to gold while depositors pulled out currency, a double drain. The Federal Reserve responded by raising its discount rate in October 1931 to defend gold rather than expanding the money supply, deepening the deflation. The failure to act as lender of last resort was, in the words of the Federal Reserve's own historians, its most serious sin of omission. The NBR dates the contraction from a peak in August 1929 to a trough in March 1933. The numbers are staggering. Unemployment rose from roughly 3% in 1929 to about 25% by 1933. Real GDP fell roughly 30%, industrial production dropped about 47%, and from 1929 to 1933 more than 40% of America's banks suspended operations, over 9,000 institutions, wiping out the savings of millions with no insurance to protect them. The downturn hit bottom in March 1933 when the banking system itself collapsed, with state holidays spreading from Nevada to Michigan, and even the Federal Reserve banks closing on March 4th. The spiral was stopped by government action, not market self-correction. At 1 a.m. on March 6, 1933, the newly inaugurated President Roosevelt proclaimed a nationwide bank holiday, shutting the entire system. The Emergency Banking Act, passed March 9th, let the Reserve banks issue emergency currency and provided for reopening only banks that examiners found sound. In his first fireside chat on March 12th, Roosevelt told Americans it was safer to keep their money in a reopened bank than under the mattress. The public believed him. They redeposited about two-thirds of the cash they had hoarded, and on March 15th, the Dow rose 15.34%, its largest one-day percentage gain ever recorded. To write the right rules, Congress first had to diagnose the failures. The Pecora investigation, which began in 1932 and gained force when Ferdinand Pecora became chief counsel, exposed how the system had been wired to fail. Its first target was Charles Mitchell of National City Bank, the same banker who had encouraged buying during the 1929 crash. Under questioning, Mitchell admitted his 1929 income of $1,206,195 while paying no income tax, and the bank was shown to have packaged bad loans into securities sold to unwitting investors. The public outrage helped galvanize the three reforms that followed. The diagnosed causes mapped directly onto the cures. The Securities Act of 1933, signed May 27th, was the Truth in Securities Law. It required investors to receive material financial information on securities offered for public sale and prohibited fraud and misrepresentation. The Securities Exchange Act of 1934 created the Securities and Exchange Commission, recognized as founded on June 6, 1934, to oversee exchanges and brokers and to mandate ongoing disclosure. Crucially, it gave the Federal Reserve authority to set margin requirements, attacking the exact leverage that had helped trigger 1929. Joseph P. Kennedy became the SEC's first chairman. The Banking Act of 1933, known as Glass-Steagall and signed June 16th, erected a wall separating commercial banking from investment banking, ending the conflict of interest the Pecora hearings had exposed. The same act created the Federal Deposit Insurance Corporation, its most controversial provision, insisted on by Representative Henry Steagall over Roosevelt's veto threats. Deposit insurance took effect January 1, 1934, covering deposits up to $2,500, soon raised to $5,000. The result was immediate and decisive. Only 9 banks failed in 1934, compared with more than 9,000 in the years before. The bank run, the central mechanism that had turned the recession into the Depression, had been switched off. The rules held for about 66 years. Then, in a climate of deregulation, and after the 1998 Citicorp Travelers merger had preempted the law, the Gramm-Leach-Bliley Act, signed November 12, 1999, repealed Glass-Steagall's separation of commercial and investment banking. The Fed's own history flags that the 2007 to 2009 financial crisis caused many to question whether this remerging of banking and securities extended the safety net and intensified the too-big-to-fail problem, the very concentration concerns Glass-Steagall was written to prevent. Note that economists genuinely dispute the repeal's role. Critics say it enabled risk-taking, while others, including a Brookings analysis, note that the firms that failed in 2008 engaged in activities that would have been allowed under Glass-Steagall. The next great crisis arrived with familiar shapes. From late 2007 to mid-2009, by the Federal Reserve history account, about 8.4 million jobs vanished, unemployment peaked at 10%, the S&P 500 fell 57%, and household wealth dropped roughly $17 trillion in inflation-adjusted terms. Congress answered with the Dodd-Frank Act, signed July 21, 2010, whose Volcker rule partially redrew the 1933 line by restricting banks' proprietary trading. But the single most durable legacy of the Depression sits quietly on your bank statement today. FDIC insurance, which began at $2,500 in 1934, now guarantees $250,000 per depositor, per insured bank, per ownership category. It is the exact protection that the roughly 9 million wiped-out depositors of the early 1930s never had.